Hello world, welcome back to our channel. If you're new here, my name is Tommy, and every week I make videos about personal finance, investment strategies, and everything in between. Interested in such topics? Subscribe to our channel to stay up to date and join our community of like-minded individuals. Today we're going to be discussing earnings. What are the various forms of earnings that get reported, and how should we be using them as investors? Let's get started, shall we? Welcome to Earnings Explained. So in this video, I'll explain what are the various forms of earnings, then we'll go through how to use each metric. Finally, we'll share some key takeaways. First of all, earnings was a pretty confusing term to me when I first started out investing, because it can be used to describe any of the following types of metrics you see on the screen. But specifically, earnings is also its own metric. So let's start off with what that means. Earnings is essentially a company's after-tax net income, and this is what the company's bottom line or profits is known as. So we can interchangeably call this the company's bottom line or profits. Next, what is EBT or EBT? It stands for earnings before taxes. What it does is it takes the tax that was deducted to get earnings and it adds it back. So what is this used for? It can be used to adjust the effect of corporate tax to show the profitability in a perfect world where businesses don't pay tax. What about EBIT? So EBIT stands for earnings before interest and taxes. And what this is it takes the earnings and adds back the interest and taxes that was deducted. So what it is for is to adjust the effect of interest payments to show the profitability in a perfect world where business don't have to pay interest on their debt. Next, what is EBITDA? So EBITDA stands for earnings before interest, taxes, and amortization. And what does this do? So this adds interest, taxes, and amortization back into earnings. So the new one is amortization. So this shows the profitability in a perfect world where loans and intangibles do not lose value over time. Finally, what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation and amortization. So the new one that we are adding back now is depreciation. And what it does is it adjusts for the effect of depreciation to show profitability in a perfect world where equipment does not lose value over time. If it sounds ridiculous to you, that's because it is. Here's what Warren Buffett and Charlie Munger had to say on the matter.
Any management that doesn't regard depreciation as expense is living in a dream world. But of course, they're encouraged to do that by investment bankers who talk to them about EBITDA, and then certain people have built fortunes on misleading investors by convincing them that EBITDA was a big deal. And when we see companies that say, hey, we don't pay any taxes and because we don't have any earnings for tax purposes and don't count depreciation and all of that, that's coming, in our view, many times that's coming very close to a flim-flam game. I get these people that show me, they want to send me books with EBITDA in it, and I just tell them, I'll look at that figure when you tell me you'll make all the capital expenditures. If I'm going to make the capital expenditures, there's very few businesses where I think I can spend a whole lot less than depreciation year after year and maintain the economic strength of the business. So I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. It's just as much as the expenditure for lights. It's not a non-cash expense. It's a cash expense. You just spend it first. The cash is gone, and it's a delayed recording. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings?
I knew he'd do it sooner or later, folks.
And the man,
He made it through the morning, but never all day.
Next, let's take a look at how each of these metrics are used. First, how is earnings and net income used? Earnings and net income is used when you want to ignore only capital expenditure. So this is the true profit of a company without lumpiness from capital expenditure. What does this mean? It means it ignores the capital expenditure such as building new factories and equipment. This can be a very large amount for certain industries such as oil and gas and mining companies. What about EBT or EBT? So this is used when you only want to ignore taxes. So perhaps a company has specific write-offs on taxes or tax reliefs and you don't want to account for that. This is one way to remove it from your analysis. EBIT is used when you want to ignore the interest payments on debt as well as taxes. EBITDA is used when you want to ignore taxes, debt, and amortization. And finally, EBITDA is used when you want to ignore taxes, debt, depreciation, and amortization. So what is it used for? It's actually measuring the profit of a business, assuming only operational costs matter. And operational cost refers to the bare essentials required to stay afloat in the business, such as labor costs, marketing, and the cost of goods sold. Finally, we have revenue or sales, which we have not talked about because technically this is not part of earnings. But this is usually seen as one of the first items in annual reports or company presentations. It ignores all costs and can sometimes be used as a proxy for the business gaining market share. Of course, there are a lot of assumptions baked into that. Okay, so what have we learned from the various types of earnings? First of all, the various types of earning metrics are just used for normalization purposes. So for example, a company has high revenue growth but low EBITDA can mean something. A company that has high EBITDA but low earnings can also mean something. In my opinion, it's more useful when comparing in relative terms rather in absolute terms. So for example, two companies that have very similar debt profiles and whose products depreciate more or less the same over time, EBITDA might be useful to compare between them. However, I feel that earnings and free cash flow are more realistic portrayals of profitability. Even for businesses that have extremely high margins, such as Google or Microsoft, the cost of business is never negligible. And as responsible investors, we should make sure that we account for this in our intrinsic value estimates. We hope you enjoyed our breakdown of the various types of earnings. Which ones do you use as an investor and why? Let us know in the comments down below. If you're interested to hear more from us, subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you found this helpful, share this with your friends and family. We'll see you in the next video.